For 25 years, Ronald Read pumped gas at a service station. After retiring from that, he spent another 17 years sweeping floors as a part-time janitor at a local JCPenney. He drove a second-hand Toyota, chopped his own firewood, and lived in a house he bought for $12,000. When he died in 2014 at the age of 92, his estate was evaluated. He left behind a fortune of over $8 million. There was no secret inheritance. He never won the lottery, and he certainly never set foot in an Ivy League finance class. Accumulating capital is a rare domain where academic credentials and raw intellect often lose to patience and temperamental discipline. To understand how a man earning minimum wage outpaced seasoned investment bankers, we have to look past the math of his portfolio and examine the psychology of his daily decisions. Building lasting wealth relies on a soft skill, how you behave, far more than the hard science of what you know. The first major behavioral track that derails wealth creation is the human instinct for social comparison. A highly specialized doctor earning $500,000 a year can easily feel financially secure. That security holds steady right up until he buys a vacation home and realizes his new neighbor is a corporate CEO taking home $10 million a year. Yet even that CEO can feel inadequate if he attends a charity gala and stands next to a cultural icon like Michael Jordan, whose brand empire has built a net worth of over $2 billion. And if a $2 billion athlete sits across the table from a tech founder like Jeff Bezos, his entire fortune suddenly looks like a rounding error against a net worth of $200 billion. Capitalism is exceptionally efficient at generating two things: extreme wealth and extreme envy. This dynamic pushes people to constantly upgrade their lifestyles and take on dangerous amounts of leverage risk just to keep pace with the people around them. Without a strict internal definition of enough, the psychological urge to compete will eventually force an investor into making fatal financial errors. Ronald Read bypassed that cycle entirely. Instead, he relied on a slow, invisible engine: compound interest. This graph tracks two hypothetical investors over a 40-year timeline. The first starts at age 20, investing a small amount every month. The second starts at age 30, attempting to catch up by investing a significantly larger monthly sum. As the timeline accelerates toward year 40, the math diverges. Even though the early saver contributed less total principal over their lifetime, their final portfolio value violently breaks away, ultimately doubling the late saver's total. This reality feels deeply unintuitive. The human brain is wired to expect linear, step-by-step growth, making it incredibly difficult to grasp the sheer power of geometric duplication. Ronald Read understood this. He didn't spend his wages on status symbols to impress his neighbors. He bought decades of uninterrupted time in the market. In the long game of accumulating capital, patience proves to be far more profitable than a massive starting income. Knowing that time is the heaviest lever, the practical question becomes how an average earner can safely leave their money in the market for decades without losing it. The most reliable tool for this is the index fund. It is a passive vehicle designed to track the entire market, eliminating the need to guess which individual stocks will succeed. Attempting to actively manage a portfolio or relying on expensive hedge funds introduces management fees. Over 30 years, a 1 or 2% annual fee acts like a persistent friction, steadily eroding the compounding returns. By holding a tiny slice of 500 massive corporations at once, an investor achieves extreme diversification. If one single business collapses, the overall portfolio absorbs the shock and continues to grow. Consistently owning the entire scoreboard offers a mathematically sound and psychologically secure strategy, removing the impossible task of trying to predict the individual players. But the compounding engine requires a specific, hidden psychological toll for admission. That toll is volatility. The market guarantees periods of inevitable, severe decline. When historical crashes hit, chaos takes over the trading floors. Massive panic sets in, forcing average investors to abandon their carefully laid plans. Watching 20 years of disciplined savings evaporate in a matter of weeks is emotionally devastating. The pressure mounts daily. Friends, family members, and glaring red news tickers all urge you to sell immediately before there is nothing left. But these severe market drops are not a fine for making a financial mistake. They are simply the ticket fee required for long-term growth. If you view volatility as a penalty, your instinct will be to avoid it. If you accept it as a fee, you pay it, weather the storm, and stay seated. Surviving this fee without breaking requires maintaining a strict financial safety net, ensuring you are never forced to liquidate assets during a panic just to pay the rent. Ronald Read's true genius lay precisely in his emotional endurance. He held his investments steady through recessions, global wars, and multiple catastrophic market crashes. While highly educated professionals panicked, liquidated their portfolios at the absolute bottom, and stalled their compounding engines, the janitor quietly held his ground. The math of the market is readily available to anyone, but if you lack the emotional discipline to survive the terrifying drops, you simply cannot reach the extraordinary peaks.